Hello guys and welcome back to the channel. In today's video I'm going to be talking about the importance of mastering sniper entries in the Forex markets and how it can be done. If you haven't already, please subscribe to the channel. These videos are coming out weekly, so if you want to stay up to date and keep getting free tips, then be sure to subscribe. So now let's get into the video. So the first thing I'm going to touch on is risk to reward. Now you might have heard this before if you have some slight knowledge on Forex. Basically this is what determines how much you risk on the markets and how much you could potentially gain in return for this risk. So let's say you have a trade that is 1 to 2 risk to reward and your risk is 1%. So every 1% you risk, if the target is hit, then you return 2%. So 1% returns 2%, 2% would return 4%, and so on. However, if you lose this trade, you will lose this 1% of your capital. So I hope this makes sense. If it doesn't, I'm going to hop over to the charts anyway and do a bit of a walkthrough of the risk to reward tool and how it works. Okay, so now you can see that I've put up a risk to reward tool in the form of a sell position, so you can either have it as a sell or a buy. The colors I've changed so it can indicate the area where if price enters here, the red zone, that's when we're in drawdown, and obviously if it hits the top and exceeds this top area, then we're taken out for a minus 1% loss. And then the green area indicates our profit region, and the bottom of it is our end take profit zone, and this line here indicates the entry position. So this is the three main parts of a risk to reward tool: your take profit area, your entry point area, and your stop loss area. So here we can see our risk to reward ratio currently is 4.52. Now if I reduce my profit target, obviously our risk to reward lowers as we're not targeting as big a move. So if we take it back to 4.52 for this example, now watch what happens when I reduce the size of the stop loss, keeping the entry point exactly where it was. You can see that the risk to reward increases. So our same target can be kept, but if we can manage to enter the markets with a smaller stop loss, then this allows for a greater risk to reward and ultimately more profit. Now this is important to note because usually your profit target is the hardest variable to change. And this is because your profit target, if it's not a hard take profit every time, so some people's plan would be, every trade you take, you set your take profit at 2% no matter what. If you're risking 1%, doesn't matter about supply or demand. But I recommend that you place your take profit area at a region of supply or demand. If you place your take profit beyond the next supply or demand region, it's going to struggle to potentially break this area and go on into hitting your take profit. So this is why it can be hard to change your take profit, and it's the hardest variable to change. So this leaves us with two other options. Our entry point can be improved upon and our stop loss can be reduced. Now, if we can find a way to change our entry position, still get tagged into the market, automatically we don't need to change our stop loss. If we can keep it in the same position as normal, but change our entry point, then this will reduce the stop loss size and ultimately increase the risk to reward, which is what everyone wants to do. So how do we determine this better point of entry? So just as a quick example, I'm going to keep this as it was. And I've highlighted that there's been a 15-minute break of structure to the downside, indicating that the current trend on the 15-minute time frame is bearish. So what do we want to do? Well, following the trend is the best option. Now, most of these traders that don't know how to master sniper entries will enter on the open, which is this part of a supply zone. So if we play price forward with our entry on the open of this supply zone, you can see we get tagged in, enter quite a decent amount of drawdown before then hitting take profit. Obviously 4.5% is very good, but there is a way to increase this risk to reward. The current risk to reward entering on the open gave us 4.5%, but we can increase this. And what I do is I use the Gann chart tool. So I go from the open of the supply or demand zone, drag it to the top, and I use the EQ or the midpoint as my reference of where I'm going to execute my position. You can see now doing that has allowed us to keep the stop loss the same, the take profit the same, but increase our risk to reward by an extra 3.21%. So you can see the market stayed the same, so we haven't changed anything there because we can't, it's out of our control. All we've done is selected a deeper entry point in our supply zone to gain a larger risk to reward ratio. Now obviously this is something I've done plenty of backtesting on, and it doesn't work on every trade. There are some rules that I've implemented to know when to enter off the EQ and when to enter off the open of a supply or demand zone. Now this supply zone is over 10 pips. This blue tag here indicates the open and the close here. If a supply or demand zone is over 10 pips in size on the 15-minute time frame, then the likelihood of the price tapping the EQ is much higher, and therefore I look to enter on the EQ of this zone. Anything under 10 pips in size, I usually enter on the open. Chances are price will retrace to the open of the supply or demand zone, maybe slightly into it, but it doesn't always tap the EQ. So this just allows for maximizing risk to reward ratio, and it allows you to be tagged in pretty efficiently so you know exactly where and when to get in and out of the markets. I have developed this plan through months and years of backtesting data, so it suits me and my style of trading. But obviously, to fully understand when to use this, you also need to know when a swing trend is changing, how to reference high time frame bias with your lower time frame bias, internal market structure, perhaps even fractal market structure at times as well. And the most important of all, actually understanding market structure itself and how supply and demand is built. And all of this, of course, is covered in my own course. And if you're interested in this, I will leave the link in the description for my free course, as always. And if you enjoy that, then you can go on to the next stage and we can talk more about this technique that I teach, and you can see for yourself how it works and all the different confluences used to be able to get to this point of trading. But this is how I master my sniper entries. So I hope that you enjoyed this video, and if you did, if you could give it a thumbs up, I would massively appreciate it, and be sure to subscribe to see the future videos.